Good morning, everyone. It is Monday, November 27th. We just got off the Thanksgiving weekend. So one thing that we want to keep in mind this week is we might treat it sort of like a fragmented week, sort of like a holiday week, because there is usually this weekend is one of the heaviest travel days of the year as everyone is flying back home. Sometimes there's travel delays, sometimes people just delay, try to beat the rush or miss the rush. So oftentimes traders take a little bit of time before they ramp up during the week because some people may not get into the office on time. So we are going to treat this week sort of like a fragmented week where we don't have the full trading week. Lower volume today, increasing volume tomorrow, and into Wednesday will probably be at full speed. So the volatility today may be slightly increased. So we want to make sure that we're careful of any news events, no news events that are coming up. So let's take a look at that. We'll take a look at how futures are opening up. And futures random down, but random, just not that much. We're looking at about 0.15% across the board, zero point 0.1 to 0.15%. So really not doing much. 10-year note slightly up. So bonds look like they're going up a little bit. Let's take a look at our economic calendar. See, so we have new home sales today. That will affect the housing markets. We have some pending home sales over here, and that looks like Case-Shiller. We have quite a bit of housing data, so we probably want to take a look at XHB, which is just consolidating. So we may see a breakout based on the data, depending if it's wildly different than expectations. And then XLRE, same thing, consolidating right at that MA200. So there is potential for movement based on this data. We're going to want to watch out for that. Other things coming up this week, consumer confidence, that's going to be really big. GDP, that's going to be really big. Personal income and outlays, this is going to be really big. So we've got a lot of data coming out. So there is potential for us to really start moving this week, whether that means a pullback like we've been anticipating, or if this market is just crazy strong, then we'll keep moving upwards. But at some point, there does have to be that pullback. It doesn't matter how strong your data is. The longer we stretch this out, the harder that pullback is going to be. Let's take a look at this one, especially personal income and outlays, because part of personal income and outlays is the PCE. PCE is the preferred measure of inflation that the Fed uses. We look at CPI, we look at PPI, we look at all those other things, but PCE has particular emphasis, excuse me, with the Fed, because it's really how much each household is actually spending and how much they have to spend in order to run their household, to continue to buy their electricity, to continue to buy their food, to continue to buy their gasoline. So, excuse me. So PCE is going to be a really important one to watch, and this one is coming on Thursday, I believe. Yeah, Thursday. So we really want to see how all of this data starts to stack up for the week and how much the market is going to move because of each piece. So day by day, as each piece of news comes out, we're going to be watching carefully at the time that it comes out for market moves. On our FedWatch front, looks like reason is starting to come back, at least in December. We have some pricing in of the potential for a rate hike. I don't really think that's going to happen in December or in January because the Fed needs time to see the effects of the rate hikes that they've been doing so far. Now that they're getting some clues that inflation seems to be coming down, we need to figure out how sticky that is. Is it going to continue to go down with the rates that we have right now, or is it going to pause, or is it going to go back up and we need more rate hikes? Right now, nobody knows. We just have to wait and see how that data comes in, and then what the correct policy would be going forward. So in January, we've got priced in another potential for rate hikes, and then March, we still have, to me, so way too optimistic of people to believe that we're going to move these rate hikes. We're going to move these interest rates down. Like I said last week, there is no reason for the Fed to decrease rates unless we start hitting a recessionary period or a heavy deflationary period. So the normal thing for the Fed to do is just stop. Once we've raised rates enough and we see inflation starting to come down and heading towards the 2% level that is their target, they're just going to stop. There's absolutely no reason for them to stimulate unless we overshoot that 2% and go down to 1%, 0%, negative percent. So there's really no reason for them to, by March, to expect that by March they're going to start cutting rates, unless you believe that inflation is coming down so hard and so fast, we're going to overshoot 2%, which in my opinion is way far-fetched. So I wouldn't put any credence on this, and we'll just take a look at the December and January numbers for now. We'll worry about the March levels when we get to January. Over here in the SPY, let's see how the futures developed, because right now they're just still randomly down. Looks like they're maybe curving back lower. So let's take a look over here and take a look at our futures. So that's really interesting. In the open of the futures, we actually headed down, and we headed down quite significantly before bouncing a recovery until we're looking at it right now, where it looks like it hasn't moved that much. But we are now crossing over. This has just crossed over to a downtrend. Before, it was bouncing on that MA200 on the 1 minute level, but we crossed below and then we bounced off of it again. Now, normally I don't look at intraday results with these moving averages. We don't normally apply technicals heavily to the intraday, but a level like a MA200 is still appropriate. Institutions are still going to look at the MA50 and MA200 even on an intraday level if they are going to be actively trading in the intraday markets, and they definitely do that in the futures markets. They don't necessarily day trade the equity markets or the indices, but they will day trade futures. So this is significant. This breakdown is significant, and that gives me, given that we were significantly lower earlier, we could head down and match those potentially during the trading day today, the normal open hours for the equities markets. So I'm going to label this as a negative bias for the day in the equity markets. Bonds, the interesting thing is the same thing happened. We were up all morning and then we started to break down. Looks like we're still higher than where we closed on Friday. But the interesting thing about Friday is that we had this little fake out where we broke above that ascending triangle. And it looked like we might continue to go up. A lot of people got really enthusiastic about this. And today, that happened on Wednesday. And Friday, we just came back down into that same range of the ascending triangle. And if we continue to move lower today, then this becomes much more likely that it is no longer an ascending triangle. It just is a flat. We just found a new resistance right here, and we're bouncing back down. But we'll see. We'll have a much better idea after this week, after we get 4 more days of data or 5 more days of data. We'll get to see how this is developing. If it moves downward, that's pressure on the market, especially on tech. especially on the NASDAQ, because the NASDAQ yield competes directly with the bond yield. And if the NASDAQ yield is not significantly higher than the bond yield, then the yield that you get for the risk that you're taking is not enticing for institutions, and they'll start moving their money towards bonds instead of the NASDAQ. What that means for us is we have to be aware of the sector rotation that has been happening. For a really long time, for basically all year, tech has been leading. So if I hit this 6-month average, you can see that semiconductors and tech are at the very top. The Magnificent Seven, the semiconductor revolution is really, the AI revolution is really what drove the S&P 500 for most of the year. And there's outsized gains in technology and semiconductors, which means that tech and semiconductors was the leading sector, and they were the leading stocks. So what happens in a normal cycle is the leaders obviously lead. They go first, but then you have what are called the laggards. The laggards have to catch up, or the leaders start to dip a little bit and the laggards catch up. The market doesn't just go, hey, the leaders went up and then now everything's coming down and then everything else just goes steady. The rest of the sectors participate in that move. They just do it later. That's why we have leaders and laggards, or we call them leaders and laggards. So the laggards will catch up, and then together there will be a sector that will be the leading sector on the down move, and then the laggards will follow on the down move. But we are in an uptrend, right? We crossed over into the uptrend right here at the end of October. We had confirmation of that in the last few weeks, but this was the move for the uptrend, which means our expectation is still the market should still continue to move up, but is no longer going to be led by tech. The laggards are going to catch up, and that means more likely blue chip stocks. And blue chip stocks do tend to become the focus towards the end of the year as institutions are reallocating for year end because they want to see it continue to. So at the year end, the blue chip stocks seasonally do a little bit better at the end of the year. So there is a rotation into those blue chip stocks. So everything is fitting well this year in this movement. So the sectors that we're going to focus on, this is a little bit different than our normal sector rotation, is we say, hey, which ones are the strongest? Because the expectation is that the strongest sectors continue to be strong and lead. But at some point that has to end. So during a normal cycle, during the upward swing of the cycle, that's absolutely true. And that is our normal state. We don't stay in the peaks and valleys for very long. The majority state is the space between the peaks and valleys. So majority of the time, the leaders are going to lead. And that's how we allocate our money. But right now we have to recognize that the leaders are probably nearing their peak, and that they're not going to start falling and the laggards are going to move upwards. So in this particular sector rotation, it's not the normal behavior. It's not the majority of the time behavior. We're actually going to move into the ones that have been performing weaker in anticipation that they're going to start leading. And which ones do we go for? We go for the ones that are more like the blue chip stocks. So the ones that would be part of the diamonds right here. So that's what we're going to be looking at. And so if we look at Diamond, DIA, they've been really, really strong. They are in need of a pullback as well. And so when we pull back, or just say we consolidate, one of those two scenarios, at the end of that pullback or at the end of that consolidation, our expectation is that the money is going to move into the Dow, the blue chip stocks, rather than back into tech. So we're going to be watching out for that very carefully. We do need that pullback or the consolidation to happen first. And that consolidation or that pullback could look like a pullback to the at least the +1 ATR, or you could hang out until that +1 ATR catches up. So for example, over here, we went up that +3 Keltner channel, and then we pulled back to the +1 Keltner channel and beyond. Over here, we touched it, pulled back to the +1 ATR. Over here, we touched it, we pulled back to the +1 ATR. We followed the +3 ATR, we pulled back to the +1 ATR and beyond. Blue chip stocks. What are blue chip stocks? They are traditionally the safe stocks, the ones that move up slowly and steadily. They're the mature companies inside the markets. They have dozens and dozens of years of history, and they have slow, steady growth. They're the ones that are constantly being held by institutions because they are slow, predictable income. So these are companies that are mature. They are no longer in their growth phase. They're now in their cash cow phase. So an example would be IBM. IBM is no longer growing at a tremendous rate. It's growing at a slow and predictable rate. It's not Tesla. Tesla's all over the place, right? It's huge growth, huge booming, and its stocks are swinging wildly. But IBM, Disney is not a huge growth stock. It just has steady growth. Coca-Cola is not a huge growth stock. It just has steady growth, and it has predictable movement. So those would all be blue chip stocks. Okay. So a couple more examples right here. Hit the +3 ATR, pull down to +1 ATR, held there for a little bit, then moved down. So you see that it's very normal after we hit that +3 ATR to pull back to that +1 ATR and then decide, is it going to continue to move up or is it going to move down? And sometimes, I haven't seen an example yet in the diamonds, but sometimes we just hang out. Let me see if I can find a good example. Let's look for the SPY. I don't want to spend too much time on this, so if I can't get a quick example. Okay, here we go. I don't know why, but I just lost the orange +3 ATR, but this hit the +3 ATR Keltner channel, and then it moved down. It did move down to the +1 ATR, and it recovered. So that's not a great example. Sorry. And I've lost my +3 ATR Keltner channel, so I'm going to give up on finding that perfect example. Actually, you know what? I was looking at, let me reload this real fast. I was looking at Starbucks this weekend. And if I recall correctly, you can see that Starbucks is leading. It was been at this +3 ATR. Then it just went sideways until it touched its +2 ATR. And then it continued to hit its +3 ATR. Then it pulled back to this +1 ATR and then is continuing to move downwards. So this is a decent example. So if I said, hey, we've been up at this +3 ATR for a little while, let's wait until we pull back to a +1 ATR. So I hold right here and I see it touches the +2 ATR, +ATR, never went to the +1 ATR, and oops, it went against me back up to the +3 ATR. But guess what? If I just hold a little bit longer, it does pull back to that +1 ATR. And at worst, I'm just break even. If I did that strategy, I didn't lose money if I waited for that +1 ATR, but I did break even. I didn't make money, but I also didn't lose money. So the normal expectation of holding or hitting that +3 ATR, and especially if we hold for a little while, is a pullback to at least to the +1 ATR. In this case, we gapped down hard to the EMA 20, and then that day traded all the way down to the -2 ATR. But our normal pattern is we cannot sustain long-term movement at the +3 ATR. We will consolidate, and even if we go back to the +3 ATR, we will consolidate again or pull back to, at the very least, the +1 ATR. So that's what we're sitting here waiting for on the S&P 500, on the Dow Jones, on the QQQ. So we've been up here at this +3 ATR. We just need to move down and touch that +1 ATR, or we need to go sideways long enough that that +1 ATR comes up and touches. In the QQQ, we are a little bit ahead, I believe. So we are still following that +3 ATR, but on Friday, you see how we dipped down. Tuesday, we kind of dipped down, but Friday, we dipped down more significantly. There's more distance over here between the +3 ATR and where we were on Friday. So we're starting to see that weakness in the NASDAQ. So what was that? Another way of saying that is we're starting to see that weakness happen first in the tech and the semiconductors, the ones that led the way. And so now is the time for the laggards to start catching up. But we will pull back altogether at the same time if we do have a pullback. And then the laggards for the year can catch up. So I talked about that for a really long time, and we are now 9 minutes before the open. So we'll leave it right there. In terms of day trading, go ahead. If you're inclined to day trade, the volume should start to pick up today and then continue to rise to normal levels into Wednesday. So we will see you in the aftermarket, and we'll see how the day goes. Have a great day, and I'll see you in a few hours.